I have lived long enough to watch people argue over the wrong question with extraordinary confidence. They love to ask whether something is a bubble. They asked it in the late 1960s when investors decided the right collection of glamorous companies could justify any price. They asked it again when the internet arrived and people confused a revolutionary technology with a sound investment. They asked it when houses stopped being places to live and became chips on a table. Now they ask it about artificial intelligence. I understand why they ask it. A new technology captures the imagination. A few companies become symbols. Their stock prices race upward. Everybody notices the spectacle. Everybody wants to know where the top is. But that is not the question I would start with. When I look at this period, I do not begin by asking whether artificial intelligence is real. Of course it is real. I do not begin by asking whether it will matter. Of course it will matter. Electricity mattered. Railroads mattered. The internet mattered. A technology can transform the world and still leave a graveyard full of investors who paid too much, financed too loosely, or trusted the wrong arithmetic. The useful question is not whether the technology is genuine. The useful question is who is paying, who is recording revenue, who is carrying debt, who is carrying risk, who is pretending not to carry risk, and who will be left holding the bag when cash returns fail to match the promises. That is where the whole thing becomes interesting. A lot of people look at the AI build-out and see a bubble. I think that description is too gentle. A bubble at least suggests an asset that can be sold to someone else before the music stops. A bubble suggests a market price that can crack. A bubble suggests a moment of recognition. What I see is more dangerous than that. I see a system that consumes capital long before it proves durable economics. I see suppliers financing customers, customers signing enormous commitments against relatively tiny present income, landlords and data center operators expanding into the fog, private equity buying the real estate and power infrastructure around the machine, and local communities being told that the future has arrived just before they receive the utility bill. That is not a simple bubble. That is a black hole. Money goes in, stories go out, profits appear on paper, stock prices rise, still more money goes in, and because each participant uses the rising price of the previous participant as confirmation, the whole structure develops the appearance of proof. I have seen this habit before. Human beings love circular validation. If a lender lends to a buyer so the buyer can purchase from the lender, somebody in the transaction will still say demand is strong. If an investor funds a company and the company uses the money to commit to the investor's own ecosystem, somebody will still call it strategic alignment. If a landlord borrows heavily to build capacity for a tenant whose business model still depends on more outside funding, somebody will still call it the infrastructure of tomorrow. When enough people are paid to keep the circle moving, even the most fragile system can look inevitable. That is the first thing I would want an ordinary person to understand. You do not need to hate AI to be worried about the money around AI. You do not need to deny technological progress to recognize financial engineering. You do not need to become a cynic to notice when the arithmetic depends on everybody standing in the same shallow pond and calling it an ocean. The public sees a handful of famous names and thinks the game is simple. A lab makes a model, a chip company sells chips, a cloud company rents out compute. A few enormous technology firms invest. That is the cartoon. The real system is a loop. A lab needs money to train models and buy compute. A supplier wants demand to appear endless. A cloud provider wants long-duration commitments. An infrastructure owner wants occupancy high enough to justify leverage. A private lender wants yield. A private equity firm wants appreciation. A government wants national advantage. A politician wants jobs and headlines. A market wants a narrative large enough to support the next move in price. Once all of that is tied together, it becomes very hard to separate genuine demand from manufactured demand. It also becomes very hard for anyone inside the machine to slow down voluntarily. I have always trusted incentives more than slogans. If a company is rewarded every time it announces a larger commitment, it will announce larger commitments. If an investor is rewarded for attaching itself to the dominant hardware supplier, it will do so. If a data center owner is rewarded by the market for expanding capacity, it will expand capacity. If accounting lets everyone report confidence long before the economics mature, confidence will be reported in heroic quantities. And if the public is dazzled by words like intelligence, autonomy, productivity, scale, and strategic necessity, very few people will stop to ask the plain old question that has protected investors for generations. Where is the cash return, and when do I get it? That question is considered old-fashioned right up until it becomes the only question that matters. Take the visible center of the machine. A chip leader makes the picks and shovels for the new gold rush. That is a fine business when demand is real. Customers are healthy, and price discipline remains with the seller. It becomes a more complicated picture when the seller also has strong incentives to help the buyer finance the rush, validate the rush, and publicly signal the rush. Then the market begins to cheer not just for sales, but for the appearance of ever larger committed demand. A lab raises money. That money flows into hardware. The hardware producer reports revenue. The market values the producer more richly. The richer valuation increases its financial flexibility and strategic power. Then more money finds its way toward the lab directly or indirectly, because the market now believes the demand curve is confirmed. I do not care what fashionable term people use for that. I care that the loop makes each participant look stronger by leaning on the next participant before the underlying economics have matured. When people want to suspend skepticism, they prefer the word ecosystem. It sounds healthy, it sounds organic, it sounds collaborative. Sometimes it is healthy. Sometimes it is simply a set of linked incentives in which each company helps the next one justify a valuation that keeps the whole chain alive. A company can call that partnership. An investor should call it interdependence. And interdependence is not the same thing as resilience. The danger grows when very large obligations are signed by companies whose present revenue would look modest relative to those obligations in any ordinary setting. If a business with $12 billion of revenue is associated with commitments that run into the hundreds of billions, I do not automatically conclude genius is at work. I conclude that capital markets are granting extraordinary trust to a future that has not yet been delivered. That trust may be rewarded. It may also be abused. During a mania, people speak as if signing a larger number is itself evidence of strength. I have never believed that. A large commitment can be a mark of confidence. It can also be a mark of dependency. And dependency is exactly what I see all over this system. The AI labs depend on chips, power, data, capital, and cloud infrastructure. The hardware makers depend on the labs to keep justifying the build-out. The cloud and data center providers depend on the labs using the capacity they are racing to build. The private infrastructure financiers depend on all of the above. The public market depends on a story of future productivity big enough to justify present prices. And because the expected gain is described in civilization-level language, almost no price or commitment seems too large in the moment. That is another hallmark of danger. The promised destination becomes so grand that all discussion about the cost of the road is treated as provincial. I have watched that happen many times. Railroads were going to transform commerce. They did. And yet investors still found ways to lose fortunes when too much track was laid for too little return. The internet was going to reshape communication and retail. It did. And yet many businesses built in that first wave were priced for a certainty that did not exist. Housing was treated as a permanent machine for wealth creation. Then the machine ran through households, banks, structured products, and balance sheets until the system itself had to admit what had been obvious all along. The mistake was never believing in the underlying force. The mistake was believing that the force excused loose financing and bad discipline. Artificial intelligence may be the most productive general-purpose technology we have seen in decades. That possibility does not immunize the current investment structure from foolishness. In fact, it may encourage more foolishness because people cannot bear the idea of missing the next foundational platform. Once fear of being left behind becomes stronger than fear of losing money. Investors will rationalize almost anything. That is exactly the emotional climate in which capital is misallocated fastest. I keep coming back to the phrase black hole because it captures something the word bubble does not. In a bubble, optimism outruns value. In a black hole, capital disappears into a structure that demands still more capital just to preserve appearances. That is a different problem. A giant data center is not a tulip bulb. It is not a cartoon on a brokerage statement. It is concrete, steel, cooling equipment, transformers, land, debt, maintenance, and power contracts. It sits there, it must be used, it must be financed, it must be depreciated, it must be serviced. If the expected demand does not fully arrive, the asset does not gracefully shrink to fit reality. It remains standing, the debt remains, the carrying cost remains, the hope remains, and hope is expensive when it is attached to an electricity meter. This is why I do not think the public appreciates how physical this race has become. People imagine AI as software floating in the cloud. There is nothing cloudy about the real bill. The real bill includes server halls the size of industrial campuses. It includes water. It includes cooling. It includes fiber. It includes transmission. It includes land bought up far from Silicon Valley. It includes rural counties waking up to a future they were never asked to price. It includes giant promises about jobs and progress, followed later by the much smaller number of permanent jobs once the construction crews leave. That last point matters. A lot of large capital projects receive moral cover because they are presented as engines of local prosperity. Construction can certainly create work, but permanent operating employment for a data center is not the same as the employment base created by a broad industrial cluster. A community may trade land, noise, water, visual space, grid strain, and long-term development flexibility for a project that looks enormous from the outside and ends up supporting a surprisingly thin layer of lasting local employment. People are told they are participating in the future. Sometimes what they are really doing is subsidizing someone else. Race for scale, power is the tell. Whenever a system needs enormous amounts of power and speaks about that requirement as if it were a manageable detail, I pay close attention. Power is not a detail. Power is the bill collector of reality. You can announce a model in an afternoon. You can announce a funding round in an hour. You can move a stock price in a minute. You cannot conjure reliable generation and grid capacity at the speed of an earnings call. That mismatch between financial speed and physical speed is one of the reasons this whole build-out worries me. Server capacity can be planned in a few quarters. Power infrastructure can take years. Permitting takes time. Transmission takes time. Plants take time. Communities object. Environmental constraints appear. Water becomes political. Every honest physical limit shows up eventually. Markets do not like limits during a mania. They prefer to pretend that every bottleneck is just one more opportunity. Sometimes it is. Sometimes it is a reminder that the story is outrunning the system that must support it. When developers begin placing gas turbines next to data centers because the grid cannot keep up, that is not a minor footnote, that is a signal. When utility rules allow the broader customer base to absorb grid upgrade costs driven by hyperscale demand, that is not a technical matter to ignore. That is a transfer. When families living paycheck to paycheck see monthly bills inch higher, so a private capital race can continue, the issue stops being theoretical. The public is already paying for the excitement. Not through a dramatic tax notice, not through a direct invoice marked AI. They pay through power costs, water pressure, land use conflicts, public incentives, and a financial system that keeps telling them the future requires one more layer of spending. That is another reason the black hole analogy fits. The system absorbs not only private capital but public tolerance. The people supplying that tolerance are rarely the ones positioned to cash out early. And then we reach the private equity and private credit layer, which to me is where the picture becomes truly dangerous. Many people still talk about artificial intelligence as if the main story were a handful of listed companies and a few famous founders. I am far more interested in the less glamorous owners of the buildings, pipes, debt claims, leases, and financing packages wrapped around the movement. That is where leverage likes to hide. Private equity loves assets that can be bought, improved, levered, and sold at a higher multiple. Data centers sound perfect for that dream. A tenant with a famous name, long contract, secular growth, scarcity, strategic importance. It is almost irresistible. So the money pours in. Firms buy data center operators, they assemble campuses, they develop land, they talk about digital infrastructure, the way earlier generations talked about toll roads and pipelines. On the surface, that sounds disciplined. But if the tenant economics are still uncertain, if hardware can become obsolete faster than the accounting life assigned to it, if utilization assumptions are heroic, and if the financing beneath the structure is expensive, then you do not have a conservative infrastructure story. You have a leveraged bet built on layered optimism. I have spent a lifetime trying to distinguish a business from a financing arrangement. A good business can survive mediocre financing. A mediocre business can look excellent under generous financing. A weak business paired with abundant financing can even look unstoppable for a while. The AI infrastructure race has many areas where the financing itself is doing more of the work than people care to admit. Private credit is especially important here. When banks retreat or stay more cautious, private lenders step forward for the yield. They tell themselves they are lending against mission-critical assets and secular growth. Maybe they are. But they are also lending into a world where expectations are rising faster than proven cash generation. Double-digit yields look wonderful until you remember that they usually exist because the risk is real. And once a structure is financed with high carrying costs, its managers lose the freedom to slow down. That is a profound weakness. If the business can only survive by continuing to grow, continuing to raise, continuing to lease, continuing to announce, and continuing to persuade, it is no longer compounding from strength. It is running on the treadmill of external confidence. The market usually notices that too late. People think failure in finance arrives with sirens. Often it arrives with silence. A project is delayed. A utilization target is missed. A tenant renews more cautiously than expected. A financing package is reworked. A valuation is held where it was because no one wants to test it. A useful life assumption is extended. A depreciation schedule is softened. A quarter looks acceptable. Another quarter looks acceptable. Then one day the difference between paper stability and economic reality has become so large that a sale default or restructuring suddenly reveals the gap that had been there the whole time. That is why I worry whenever accounting discretion becomes a meaningful source of reported strength. If the useful life of expensive hardware is stretched from 4 years to 6, profits can improve without a single extra dollar of real competitive advantage being created. I understand why managers do it. Sometimes the assets may indeed last longer than previously thought, but in a period of rapid technological change, I do not find it comforting when reported profit relies partly on the assumption that today's prize hardware will remain economically useful for much longer. The machine may physically run for 6 years. That does not mean it will remain competitively valuable for 6 years. When technological obsolescence moves quickly, depreciation can become a form of optimism. Optimism inside accounting is still optimism. The most dangerous kind of optimism is the kind presented as a technical adjustment. Investors often relax when a number is delivered in the language of accounting policy. They should not. Words do not make uncertainty disappear. Another weakness in the current frenzy is that everybody talks about demand as if it were a solid object. Demand is not solid. Demand at a profitable price is the thing that matters. A data center full of expensive chips has no magical value if the compute rented out of that center cannot earn an attractive return on the all-in cost of the build-out. That sounds elementary, yet manias train people to look at gross scale instead of economic quality. How many chips were ordered, how many campuses were announced, how much capital was committed, how many billions were authorized, how many partnerships were signed. Those are the questions of a boom. The sober questions are different. who is earning a durable return after depreciation, power, maintenance, financing, and replacement risk, who can keep pricing, who can remain essential when the market stops applauding raw expansion, who can survive a world in which demand still grows. But not enough to rescue every project started during the craze. That is the sort of future I expect. Not a clean explosion, not a single spectacular break. Something more tiring, a long reveal, 1,000 disappointments. Some labs will matter, some hardware companies will remain powerful, some software tools will become indispensable. Some infrastructure assets will be very valuable, but many projects launched under the emotional pressure of this moment will discover that being associated with the future is not the same as earning a good return on capital. That distinction never stops mattering. It is the center of investing. The market has also become fascinated with the idea that because AI may replace or enhance labor, its upside is effectively uncapped. I have no doubt the upside is large, but whenever someone tells me the upside is so large that present pricing discipline should be suspended, I hear not analysis, but temptation. Replacing labor sounds like the biggest bet in history because in some sense it is. That is precisely why the money attached to it becomes dangerous. A gigantic prize attracts giant overbuilding. It attracts moral shortcuts. It attracts political cover. It attracts accounting softness. It attracts capital that assumes even a small foothold in the future justifies a very large current valuation. A race with that many participants and that much social prestige attached to it will not self-regulate elegantly. And once governments begin framing the race in national security or geopolitical terms, the restraint becomes weaker still. That is another difference between this cycle and some older ones. This machine is not only powered by venture capital, public equities, and private finance. It is increasingly blessed by strategic rhetoric. Nobody wants to be the country that blinked. Nobody wants to be the chief executive who underinvested if the future really belongs to the builders. Nobody wants to be the capital allocator who missed the next railroad, the next cloud, the next platform, the next engine of productivity. That fear creates an extraordinary tolerance for waste. The public often hears arguments like these and assumes the conclusion must be anti-progress. I do not see it that way. I have spent my life in a capitalist system that depends on risk-taking. We need people building the future. We need entrepreneurs willing to pursue very large ideas. We need engineers who attempt what earlier generations thought impossible. But we also need language that separates technological promise from financial recklessness. Otherwise, every boom is sold as patriotism and every skeptical question is treated as backwardness. That is a terrible habit. The world does not improve when capital stops asking what it is earning. The world improves when capital funds what is useful and withdraws from what cannot justify itself. If we lose that discipline because the subject happens to be AI, then we have not become visionary. We have become excitable. And excitable capital is expensive capital. There is also a moral side to this that I do not think is discussed enough. When ordinary households hear that a new industrial wave is arriving, they assume the winners and losers will be determined mainly by innovation and merit. That is not how it works. The burden is often socialized long before the gains are. If utility customers shoulder higher grid costs, if water resources tighten, if land is consumed by projects offering thin permanent employment, if communities absorb pollution so that a remote capital stack can chase returns, if pension money and insurance money indirectly finance overbuild that later disappoints, then the system is not only speculative, it is distributive. People far from the center of the excitement are made into unacknowledged participants. That is why I always advise people to study where costs travel, not merely where revenues are booked. Revenues are glamorous. Costs are revealing. A seller can record revenue once. A community can live with consequences for decades. The same principle applies to investors. A stock can celebrate a quarter. A lender can mark a loan. A private fund can maintain a valuation. But if the physical assets financed in the rush prove less valuable than hoped, the damage travels slowly through balance sheets that do not trade frequently enough to offer regular truth. That is one more reason I call it a black hole. There may be no clean daily market price telling everybody what the real value is. Truth can stay hidden in private funds, corporate depreciation schedules, long-term leases, and financing structures that do not have to reprice every afternoon. That delays recognition. It does not eliminate it. In fact, it often makes the eventual recognition harsher because people have had so long to mistake carrying value for economic value. This is how entire industries talk themselves into stability. They mistake the absence of a quoted collapse for the presence of health. A thing can remain untraded and still be worth much less than stated. A thing can remain occupied and still be earning poor returns. A thing can remain on the books and still be economically obsolete. Markets are not fooled forever, but they are patient enough to be dangerous. If you ask me how this ends, I do not see one clean ending. I see three broad paths. The first is that a meaningful portion of the optimism proves justified. The technology improves quickly. Real enterprise value is created. Productivity rises. Some labs become durable businesses. Some infrastructure earns acceptable returns. The losers disappear. But the survivors are so important that history later remembers the period as messy but necessary. That can happen. It happened after the internet. Boom. A great many things burned. And yet the world that emerged was truly different. This is the kindest path. It still includes waste. It still includes disappointment, but it leaves behind enough productive residue that the excess looks, in retrospect, like the unavoidable price of building the next stage. The second path is uglier. The technology advances, but the economics are captured narrowly while the costs are spread broadly. Productivity gains do not flow evenly. Labor is pressured faster than new opportunity emerges. Infrastructure remains heavy, expensive, and politically protected. A handful of giant platforms grow stronger because they control chips, data distribution, and cloud environments. While everybody else becomes more dependent, that world may still produce impressive products. But it does not produce a healthy distribution of economic power. The black hole keeps pulling capital, and society is told this is the unavoidable toll of modernity. The third path is the most financially sobering demand, turns out real, but not nearly real enough to justify all current commitments. Compute becomes abundant in some pockets. Rental prices compress. Hardware ages quickly. Replacement cycles arrive before optimistic depreciation assumed they would. Some labs fail. Some campuses stay underutilized. Private credit absorbs losses. Private equity discovers that digital infrastructure purchased at peak enthusiasm does not deserve peak pricing forever. Public markets continue to celebrate the strongest players, so the broader public misses the accumulation of damage until the chain of disappointments has already moved through lenders, funds, and regional communities. That path looks less like 2008 in one day and more like years of small recognitions. I suspect reality will borrow from all three. That is usually what happens. A few giants will validate the narrative. A good many latecomers will not. A handful of assets will prove strategic. Many others will prove ordinary. The winners may be magnificent. That does not save those who finance the wrong rung of the ladder. I have always believed that new industries create two separate contests. The first contest is technological. The second contest is financial. The people best positioned to win one are not always the people best positioned to win the other. Engineers can change the world while investors overpay for the privilege of watching. Hardware can remain essential while the owners of excessive capacity suffer. A platform can reshape labor while the lenders behind speculative expansion earn meager returns. The existence of a durable industry does not guarantee the existence of a good investment at every point in the stack. That is why I tell people to resist the intoxicating effect of inevitability. Once an outcome is described as inevitable, every price begins to sound reasonable. That is when discipline matters most. An individual investor watching all this should not try to predict every twist of the machine. That is too hard. and usually unnecessary. The important thing is to understand the logic of the structure. When a field requires endless capital before proving lasting returns, be careful. When suppliers help create demand for their own output, be careful. When accounting choices noticeably brighten profits during a period of rapid technological change, be careful. When private markets hold large, illiquid, rapidly built assets at values that have not been tested in stress, be careful when the public is told the future is so important that ordinary questions about cost, return, and who pays are somehow small-minded. Be especially careful. There is another temptation worth resisting. People want a simple emotional stance. They want to say either that AI will save everything or that AI will destroy everything. Those are theatrical positions. They are poor investment positions. A better stance is calmer. The technology may be transformative. The current capital structure may still be reckless. The leaders may still be brilliant. The valuations may still be too rich. The infrastructure may still be necessary. The financing may still be too loose. The products may still improve dramatically. The returns on many projects may still disappoint. Two contradictory sounding things can be true at the same time. In markets, they often are. I do not need to know whether every founder is sincere. I do not need to know whether every politician understands the implications. I do not need to know whether every project will fail. I only need to know that the setup contains the classic ingredients of overconfidence: circular validation, massive fixed investment, layered leverage, socialized costs, private marks, ambiguous price discovery prestige, fear of missing out, and a promised future large enough to excuse all present discomfort. That combination has never made me feel relaxed. If I were sitting with a young person trying to make sense of the period, I would say something simple. Learn where the money actually goes. Do not stop at the product demonstration. Follow the lease. Follow the utility bill. Follow the depreciation policy. Follow the replacement cycle. Follow the debt maturity. Follow the local political compromise. Follow who must keep expanding to justify yesterday's optimism. That is how you avoid becoming the final source of liquidity for someone else's enthusiasm. People often ask me what kind of moat matters in a period like this. I would answer differently than they expect. The rare moat in a capital frenzy is not only technological advantage, it is the freedom to act without depending on constant outside applause. The business with the real moat is the one that can slow down if it chooses. The one that does not have to announce bigger commitments every quarter to keep creditors, landlords, equity holders, and counterparties comfortable. The one that can generate cash without constant refinancing. The one that can endure a period of lower demand without pretending that lower demand is impossible. That kind of freedom is always scarce. It becomes even scarcer inside a black hole. There will be fortunes made in AI. I do not doubt that for a minute. There were fortunes made in railroads, automobiles, broadcasting, semiconductors, software, and the internet. But the number of fortunes made by a technology does not tell you how many fortunes were lost while building it. That is what people forget. Progress has a habit of producing true believers, dazzled spectators, heroic engineers, ordinary workers, cynical financiers, and overextended investors. All at the same time, the fact that the future is real does not make the financing prudent. It simply makes the financing easier to justify for longer. That may be the whole lesson here. A bubble is a visible excess in price. A black hole is a hidden excess in commitment. Price can fall in a day. Commitment can drain a system for years. That is why I think people are still using too small a word for what is happening. They hear AI bubble and picture a stock chart. I hear AI black hole and picture a civilization-scale financing machine, drawing in chips, land, concrete, debt power, political goodwill, accounting flexibility, and public patience. I picture a structure so large that even its mistakes arrive with prestige. That is a dangerous thing. Prestige can postpone honesty. It cannot cancel arithmetic. At some point, the system must answer the oldest questions in business. What did it cost? What did it earn? How much must be replaced? Who bears the downside? What happens if growth is real but slower? What happens if demand is high but pricing weak? What happens if the leaders thrive but the ecosystem around them does not? What happens if the assets physically last longer than expected but economically matter less with each passing quarter? Those questions are not anti-technology. They are pro-reality. Reality is the only place returns are paid. I would rather sound old-fashioned and ask them now than sound fashionable and discover the answers later. When people think carefully about this period, I hope they do not get trapped in the lazy choice between blind excitement and theatrical despair. The useful posture is neither. The useful posture is disciplined curiosity. Study the machine, respect the technology, distrust the financing when it begins to feed on its own momentum. Remember that the people promising a glorious destination are not always the people who will absorb the bad economics along the road. And above all, remember that no machine, however impressive, can repeal the rule that has governed capital allocation since long before I bought my first stock. A good future is not the same thing as a good investment. In moments like this, that distinction can save you a fortune. It can also save you from becoming one more silent contributor to a system that keeps swallowing cash, swallowing land, swallowing power, swallowing patience, and calling the whole process progress, simply because nobody wants to be the first person in the room to ask whether the return is worth the cost. I have no interest in being the last person to ask.